So, is there anything that you can see between now and next week that might prevent the Fed from moving, or is that just about a done deal?
The short answer is no. I think futures markets are pricing it in almost with 100% probability. I can't remember what the latest figure is, but it's way over 90%.
So in other words, let's hope that they do.
I think it's a done deal. I think it's been well signalled. I think you know, there's no significant data that's likely to change their minds, even if we see a slightly weaker print today on the payroll number, which we're not expecting. I think the other supporting data has been so robust that actually the Fed is well justified in tightening policy next week.
With all the forward guidance we're getting from them, and we practically get someone from the Fed and Fed officials speak just about every week here, I mean, is there at all a risk that we don't see a sudden tightening coming, or is that really just telegraphed from them? What's your sense of that conversation?
I think there's a balance in terms of central bank policy, which is that they want to communicate to markets so that there are no nasty surprises, and so that markets can adjust to any changes in the monetary policy stance. But at the same time, they need to be able to surprise markets and surprise the economy in order to bring about meaningful change. So it's a sort of trade-off that they have to take into account. And I think at the moment, the balance is much more on communication and making sure that people understand what's coming so that they can adjust their behaviours and price in accordingly.
Now, you guys have come up with essentially a rough figure of how much the Fed balance sheet has to come down to sort of see that consequent move up in yields. What is that relationship?
So the crude rule of thumb we use, and this is based on a meta-analysis of the impact of Fed balance sheet expansion, is that for every $100 billion it would result in an increase in the 10-year Treasury of around about 5 basis points. Now, these things are, of course, very uncertain. There's lots of cross-currents. But I think the point is that next year the Fed's balance sheet might contract by $300 to $400 billion.
That's
which
nothing,
is, you know, exactly. So it might be 15 to 20 basis points upward pressure on the 10-year Treasury. Of course, in the whole scheme of things, that's really just noise and just, you know, within the whole context of the normal trading range. So we don't expect it by itself to have a massive impact. Of course, you have to take it in the context of everything else that's going on in the economy and its impact on markets.
Just quickly, 5 seconds or so, how many rate hikes next year from them?
2.